On today's episode, we're going to talk about interest rates. It's one of the hottest topics today, so we're going to dive in, and I mean deep dive, into the Federal Reserve and interest rates. My podcast was designed to help new and seasoned investors and entrepreneurs break free from financial confusion by sharing real world strategies they can use to build lasting wealth and freedom. All right. Well, as I said in the intro, today's topic is interest rates. And, for all my real estate friends out there that talk about rates, I'm going to really dive into this thing because I think there are a lot of misconceptions around interest rates, and in particular, misconceptions about the Fed funds rate. And so we're going to talk about the Fed quite a bit. And I'm going to kind of give you a little bit of a history lesson on the Fed and how it's made up, what it's supposed to do. And I think you're going to learn a lot on this episode. I know I did when I did the research to do this particular podcast. So, the Federal Reserve. Let's talk about the Federal Reserve first, and because that's what everybody thinks of when they think of interest rates. They think of the Federal Reserve, and the Federal Reserve sets rates, right? Well, yes and no. It sets certain rates, but it does not set all rates. And we're going to dissect that and talk about which are which. Now, the first thing I want to say about the Federal Reserve, it is neither federal nor does it have a reserve. Okay. That's that, like most things that are worded in Washington, like the Affordable Care Act. That was not about affordable care. You can say you like it or you don't like it, but it had nothing to do with providing affordable care. But that's what they worded it, and that's what they labeled it. And guess what? The Federal Reserve is not federal. That's right. It is not a federal agency. It is not. It is a private agency made up of, for a lack of a better term, a cartel. Now, I don't mean that in a disrespectful way, like a drug cartel. OPEC, the oil producing nations, have a cartel. That's not a bad thing. It's just a group of people like-minded in the same field that get together and make decisions about things going forward. And that's exactly what the Federal Reserve Open Market Committee is, a subsect of the Federal Reserve. And that Open Market Committee is the committee that gets together 8 times a year to talk about policy. Now, what you think probably is that all they talk about is interest rates and what they're going to set the interest rate at going forward. That is not all they talk about. In fact, that is not all they decide either. They decide many other things that have less of an immediate or less of a direct impact on us, but they certainly do impact the economy, and they certainly do impact inflation, and they certainly do impact interest rates. So we're going to dive in here. And what is the FOMC? That stands for the Federal Open Market Committee. And that is made up of a group of people that fall in a couple of categories. The first is the Board of Governors. There are 7 Board of Governors in the Open Market Committee, and all of them vote on the interest rate change. Then we have the Fed Bank presidents. Now, there are 12 Fed Bank presidents of Fed banks across the country. They are basically broken up into 5 groups. The first group is New York. And the president of the Federal Reserve Bank of New York is a permanent voting member in the FOMC. So he or she, and at this point it's a he, he's going to be voting as long as he's in tenure as the Fed Bank president of the New York Federal Reserve Bank. Then we have four other groups of Fed Bank presidents. In Group 1, we have Boston, Philadelphia, and Richmond. And in Group 2, we have Cleveland and Chicago. In Group 3, we have Atlanta, St. Louis, and Dallas. And in Group 4, we have Minneapolis, Kansas City, and San Francisco. And each of those four groups, one of those people is chosen to vote, and they vote for a 1-year period, and then they rotate. And then the next person will take their place voting. Interestingly, all 19 of these people, the Board of Governors and the Fed Bank presidents, all meet together for the Open Market Committee meeting 8 times a year, and they all participate in these meetings. It's just that only 12 of them are voting. And then those revolving group presidents change out on an annual basis. So you've got 12 voting members. Obviously, Jerome Powell being the Fed chairman, he is in there as one of those 12 as well. Now, the duties of the Federal Reserve, FOMC. This committee has been given a dual mandate, and you'll hear that term over and over when you hear about the Federal Reserve. There is a dual mandate, and that mandate is keep inflation low and in check, and keep employment at full employment. So let's talk about inflation first. That's the one that people are most concerned about, I would say, at this point. And right now, the Federal Reserve Open Market Committee has a goal of 2% inflation. We've heard that over and over in newscast after newscast. That's the goal. Get it at 2%. Now, a few years ago, it was well below 2%, 1.8 in 2018. But then in 2022, we had massive inflation coming out of the COVID years. And we could argue about why, we could argue about how that happened, but I'm going to steer clear of that in this particular episode. I just want to stick to the facts of what this Open Market Committee is and what it does and where we are. And then we can kind of extrapolate from that, and each of us will have to do that on our own as to what we think is coming next for interest rates. So the Federal Reserve has a dual mandate. They need to keep inflation in check, and they need to keep full employment. Well, let's first of all dissect what is full employment, right? Right now, the unemployment rate is 4.2% as of last month, and the historical average, going back quite some number of years, is 5.67. So we're at 4.2. Historical average is 5.67. So I would say, and most economists I think would agree, that we are certainly at full employment now, even though we were much lower than this just a year or so ago. Coming out of COVID, it was just an astronomically low unemployment rate. But I think that was an artificial unemployment rate based on all the free money that was sloshing around in our economy, given out by the government through various means, and there were a lot of them, that are now kind of getting washed out of the market. So we're getting back to normal. Now, full employment, most economists would say, is somewhere between 5 and 6%. Ironically, as I just said, historic average is 5.67. So that's spot on, right in the middle of where most economists are going to put full employment. So we're way lower unemployment rate, which means we have a lot more people employed than what we would expect for a period of full employment. Now, this is all very important because this is going to tie in to the decisions that this Federal Open Market Committee are going to make, okay? Because they're going to look at inflation and they're going to look at employment. And if you have a situation, as we do now, where we have at and above full employment, but you also have above target inflation, it makes sense that you're going to continue to keep a tightening or restricted policy on the economy. And that is exactly what they've been doing, and they've been doing it in multiple ways. The only one most people talk about is the Fed funds interest rate. Now, that is the rate that is set by this committee on what interest is going to be earned by banks when they borrow from the Fed. Okay, that's the Fed funds rate. So that's the interest rate that we all sit on just sit on the edge of our seats 8 times a year and wait for the Fed chairman, currently Jerome Powell, to come out and go to the microphone at 1:00 p.m. on the second day of their committee meeting and say, we have voted and this is what we're doing going forward. What we're talking about there and what we're listening to is the interest rate that the Federal Reserve is going to charge banks to borrow their money. And right now, it is set at 4.25% to 4.5%. It's a range. It's never an exact number. 4.25% to 4.5%. So that's the first thing that they decide. Also, in that committee meeting, there's some other things that happen. So let's look at a set of the duties of the Fed. One is to conduct their market operations and basically to direct the New York Federal Reserve Bank at their trading desk to buy or sell U.S. government securities in the open market. Now, that's one thing that they can do. Another thing they do is they manage the Federal Reserve balance sheet, and that's basically tied together. And what they're doing there is something called quantitative easing or quantitative tightening. So let's talk about that. If the Fed is dumping securities, which would most generally be U.S. securities, U.S. bonds, or mortgage-backed securities into the market, that is called quantitative tightening, because they are selling off these things off their balance sheet and they are taking money out of the market by selling off assets. If they're buying more than they're selling, that's considered quantitative easing because they're gobbling up assets and putting more cash into the marketplace for investment. Now, the question you have to ask yourself is, okay, I think interest rates are high. That's what most people would say. I don't, but most people say that. But what else is happening? The Federal Reserve is right now in a period of quantitative tightening, not easing. In fact, this current quantitative tightening started in 2022, and it started in 2022. Why? I just said it a minute ago. Because we had runaway inflation in 2022. So the Fed started dumping securities onto the market to suck liquidity out of the market so that there was not as much capital chasing goods and services, which pushes demand higher and creates demand side inflation. Okay? Market volatility got you stressed. One day you're up, the next day you're down. It's enough to make anyone lose sleep. That's why smart investors are looking beyond traditional stocks and bonds to diversify their portfolio. What makes ILS Capital different? While stocks and bonds swing with market emotions, our investment funds are backed by real estate notes, actual loans secured by real property. This means your investment isn't tied to Wall Street sentiment or corporate earnings reports. Instead, it's connected to tangible assets that people need, homes and commercial buildings. Real estate notes have historically provided more predictable returns because they're based on actual property values and loan payments, not market speculation. It's a completely different approach to building wealth. Ready to add some stability to your investment strategy? Visit ILS Capital at ilscapitalfunds.com/diversify. That's ilscapitalfunds.com/diversify. And learn how our real estate notes-backed funds can help balance your portfolio. Investment involves risks, including potential loss of principal. Past performance does not guarantee future results. Please carefully consider investment objectives, risks, charges, and expenses before investing. Well, they've not stopped that tightening since 2022. Here we are on the back half of 2025, and they are still dumping securities. And I could argue that that probably is having just as much an effect on the economy as the interest rate at the Fed funds level does. Okay. But it's very little talked about. Now, we are down on the Fed balance sheet $2 trillion from its peak in 2022. So they have dumped $2 trillion of securities onto the open market and taken $2 trillion out of the economy for the purchase of those securities. Does it not make sense that that might have a bigger effect on where we are with interest rates and where we are with bond rates and so forth than the Fed funds rate? Yeah, definitely. Okay. That increases rates across the economy. That increases rates even in the mortgage sector, way more than the Fed funds rate does. So while publicly we see Jerome Powell being chastised for the Fed funds rate, I think there is a bigger picture, and that's probably the only place the current administration believes people could get behind them on this indictment of Jerome Powell and the rest of the voting members of the FOMC. I think if people understood quantitative easing, quantitative tightening, and those types of things, there is a bigger argument to be made that that's probably really where this administration wants changes to happen. They want them to quit dumping so many securities into the market that it's sucking up liquidity. Now, there's a couple of other things that the FOMC does, and you can see this in their what's called their note. After the meeting and after the press conference, they will place a note. It's just a real short little thing. If you read all the transcript from the Fed, it's a heck of a read. But I just look at that note, and it tells exactly all the things that they decided to do and what their policy is going forward. It's bullet points, literally 6 or 8, 10 bullet points, and that's it. Real easy read. And it's something that after each meeting, you should get used to just going in there and looking at. It's really an easy thing to kind of let you know the rest of the story, because I promise you, the news that you're reading on all the business channels, they're not going to talk about these other things. All they're going to tell you is what they decided to do with the Fed funds rate. And that may or may not be the most important thing that they decided in that particular meeting. So let's talk about the other things that are decided in that meeting. First, they set bank reserve requirements. Now, this is important because if you want your economy to boom, if you want your economy to get going again when it's not, you would want banks to lend. And if you set their reserve requirements high, they have less to lend. Well, right now, reserve requirements are low. So that is not in a restrictive policy right now. Here's the next one. They set the interest on reserve balances at Federal Reserve banks. They set the interest rate on reserve balances at Federal Reserve banks. Now, this one you're starting to hear our current president talk about more and more. I heard a news conference the other day, and he was just chastising the Federal Reserve for paying banks to reserve their money in Fed Reserve banks. Well, you might say, well, yeah, but if they're going to put money there, shouldn't they get interest on it? Well, it wasn't always that way. Wasn't always that way. And right now, banks can put their money at a Fed Reserve bank and get 4.5% on it. That's the current rate, 4.5%. It's set the same similarly as the Fed funds rate to borrow from the Fed. And what the president is saying in his excoriation over this is, look, the Fed is now incentivizing banks to just stick their money in their bank, in the Fed Reserve Bank, instead of lending it to small businesses, instead of lending it in the economy to help get the economy going. And I think there's a real good argument for that. Why are we paying and incentivizing banks not to do business? Because that's exactly what the incentive says. It says you can park your money at a Fed Reserve bank, make 4.5% on it, and you don't have to invest it. It just sits. So that is another thing that they do. And then they also set up the overnight repurchase agreements, which basically allows the Fed to sell a security, agreeing to buy it back the next day. Again, that probably has little effect on us and the economy at large, but that's basically the grouping of things that the Federal Reserve does. So the question we have to ask ourselves is, where are we with all of these metrics now, and where are we headed? Well, where we are now is real simple. Fed funds rate, 4.25 to 4.5. Arguably, that's in the middle. That's neutral. I would argue it's neutral. Most people would not. Most people would say it's high. But I think we were artificially low for a couple of decades, from 2008 till most currently. But the biggest thing for me is not the Fed funds rate. The biggest thing for me is the Federal Reserve in a quantitative easing, a quantitative tightening, or in a neutral stance with their balance sheet? Because that is what dumps more capital into the economy or sucks capital out of the economy. We're talking about $2 trillion has been shed from the Fed Reserve balance sheet in the last 3 years. That's a lot of money to pull out of an economy, even as large as ours. So those are the things the Federal Reserve does. Now, with that in mind, let's talk about where we think things are going in the future. And it's hard to say when you have competing goals, right? The dual mandate, full employment and low inflation. We're at full employment. We still have higher inflation than what the Fed would like. Now, we could argue whether the 2.6 we're at right now, as far as the CPI inflation rate, is too high. Do we need to get it to 2? Does it have to be below 2? We could argue that, because there are some parts of inflation that are good. If maybe we'll have to dive into inflation on another episode, but there are two main types of inflation. There's the push inflation and the pull inflation. And when you're talking about prices going up, it's terrible when you have prices going up, and that's the groceries that you're buying for your family. We hate that kind of inflation. But as I said on a previous podcast, we love inflation when it means wages went up, right? Because that's the other side of inflation. The demand inflation is your pull inflation. That pulls prices higher. It pulls prices higher because you have more people wanting a limited amount of product, and the seller of that product is going to say, hey, I'm pulled in multiple directions, therefore I can raise my rate, I can raise my price, and I will still sell out of this particular product. That's demand pull that pulls prices higher. But you also have cost push, and costs going higher pushes inflation higher. And one of the biggest costs in the creation of anything is wages. I know in my office, my HR is my biggest expense. So most companies, their payroll is one of their biggest expenses. So if cost of payroll pushes inflation up, well, that's bad for the person that owns the business, great for the employees that were able to get that. And a great example of that is COVID. When we were in the COVID era, there were over 11 million unfilled jobs at one point during COVID. 11 million unfilled jobs. That's a staggering amount for this country. We're still at 7.4 million unfilled jobs, but that is down substantially from the over 11 million we faced in either 2020 or 2021. So in that time, when you had that many unfilled jobs and so few people looking for jobs, wages were going up at a staggering pace, which is part of what pushed inflation higher by 2022. That's not something we're hearing about. It's not something you're reading about, but I promise you, even in my little company of, 50 or so employees, I saw wages skyrocket. I had to pay more. I had to give huge wage increases during that time because people could leave, and they were leaving, and they were getting much higher rates where they were going. And it went down in history and had a name for it called the Great Resignation. And during that period, anybody that was a good employee could command a very high percentage of wage increase, just simply because those of us that are employers and wanted to keep our good people knew we had to do that, because if not, the next shop down the road would. Now, we're not in that situation anymore. Now we're at a situation where we have only 7.4 million unfilled jobs. Unemployment is sitting strong at 4.2%. The labor participation rate is sitting at 62.2. That's it peaked in 2020 at 67.3. Then it started falling a little bit at a time until 2015. Then it slowly started climbing back up, and then COVID just decimated it down to 62.6 in March of 2020. And we're still down at 62.2 now. So labor participation rate is still arguably low, but unemployment is still arguably low too. There are not a lot of people right now looking for jobs that can't find one. We have 7.4 million unfilled jobs, and unemployment right now, the total unemployed is only 7.2. So for the first time, it's almost at equilibrium for the first time in at least the last 5 years or more. Picture this. You found the perfect investment property. The numbers work, the location is ideal, but your traditional bank wants 60 days to close and treats your rental property like it's some risky gamble they've never seen before. Sound familiar? Here's the thing. Most banks just don't understand real estate investing. They're built for home buyers, not investors. And that's where Investor Loan Source comes in. We're a financing company created specifically by and for real estate investors. We know what rental income looks like. We understand fix and flip timelines, and we get that commercial deals move fast. Whether you're doing buy and hold rentals, fix and flip projects, or commercial acquisitions, we speak your language and we can close in days, not months. Stop explaining your business to bankers who just don't get it. Visit ils.cash/fast. That's ils.cash/fast and work with lenders who understand real estate investing. And with all of that data, it is hard for me to say the Federal Reserve should lower interest rates at the Fed funds level. It just does not, the data does not tell you they should. Now, we look at the jobs numbers that just came out, and there was much disappointment there on the jobs numbers. We had lower than expected numbers for July, but more importantly than that, we had massive revisions of the previous 2 months, which shed about 250,000 jobs from what had previously been reported as created. And of course, that has now created a shakeup in Washington. But all of this points to one thing: the Federal Reserve looking at the inflation side of this dual mandate as the more important of the two. It's the side that is not where it's supposed to be. Full employment, not that many unemployed. They're not worried about the full employment side. They're going to be worried about the inflation side. And inflation just ticked up, if we believe the government numbers, to 2.6. So that's the side they are going to be focused on. And if they did not change rates again in September, it would not surprise me. Now, 2 of the voting members of the FOMC came out in dissent in this last meeting. That's the first time in quite a while that has happened. And they both said they felt that the FOMC should have lowered rates by 1/4 point. I think that's going to give the rest of the members something to think about in September. So I will not be shocked either if we see a 1/4% drop in the interest rate, but I'll be very curious to see more so what they do with the Fed balance sheet. If they come out and they do succumb to some political pressure or some pressure from within with a couple of the other voting members to drop rates by 1/4 point, it will be interesting to see if they pair that with a further tightening on the quantitative side, or if they leave that policy alone. Because remember, they're doing more than just setting that funds rate. They're deciding what to do with the balance sheet. Do we buy or do we sell? If we buy, that has the same effect as lowering the interest rate. If we sell, it has the same effect as raising the interest rate. And I say same, it's not exactly the same, but very similar. So it would be interesting to see if they come out and try to split this in half and say, okay, you win. We're going to give you a lower interest rate. But then on the backside, the part that is never talked about in the news, they start shedding off more assets off the Fed balance sheet to suck more liquidity out of the market to make sure they stave off any potential inflation issues that may arise from them lowering the interest rate. So I know this was a deep dive on interest rates, but hopefully that helps you to understand the Fed funds rate better and what the FOMC does these 8 times a year when they get together, and understand that that rate does not affect a lot of us in real estate. Now, it does affect commercial real estate loans at the bank level. Absolutely, it does. It affects interest rates on credit cards. It affects the interest rate on auto loans. But it does not affect nearly as much the 30-year fixed on a homeowner occupied loan. Okay, it just doesn't. Those rates, and most of my real estate friends, that's what you care about. And every time I talk to one of you and you say, man, if the Fed would just lower rates, I know what you're thinking. You're thinking the Fed lowers rates and the 30-year fix just automatically drops and you're going to be able to sell houses easier or faster. And it's going to draw a lot of buyers to the market. No, that is not the way this works. That is not the way that works at all. That 30-year fixed, it's going to mirror what happens with the 10-year Treasury much more than it is going to mirror what happened with the Fed funds rate. Now, if you don't believe me, we just need to go back and look at history. If we look at the Fed funds rate and the 30-year fixed a year ago, let's look at it a year ago. Because remember, the Fed funds rate has dropped 1 full percentage point in the last 12 months. So what was the 30-year fixed prior to the Fed lowering their interest rate? Well, I can tell you, it was hovering in the high sixes, 6.7, 6.8%. That's what the 30-year fixed was. Then the Federal Reserve dropped 50 basis points, 25 basis points, 25 more in December of 24. And now, here we are, August 2025. We've had a full point drop on the Fed funds rate. And where's the 30-year fixed? High sixes. We're almost in the exact same place. A week ago, we were in the exact same place 1 week ago as we were a year ago on the 30-year fixed, even though the Fed funds rate had dropped a full percentage point. So those of you that think that those two are going to work in tandem, you are wrong. You are wrong. If you want to see the 30-year fixed come down, we need to see the yield on the 10-year Treasury come down. And if you want to see the yield on the 10-year Treasury come down, bond buyers are going to have more faith in the full faith and credit of the U.S. government securities. They're going to have more faith in our spending. They're going to have more faith that we're going to clear the debt and deficit and all those things that we've talked about in previous episodes. But understand, the more important thing for that 30-year fixed is the health of the U.S. economy, and how the Federal Reserve plays into that is in, are they quantitative tightening or are they quantitative easing? Are they selling? Are they dumping securities on the open market and sucking liquidity out of it? That's liquidity that could be used for buying 30-year fixed rate mortgages. That's liquidity that could be used for other purchases. And when they suck it out of the economy, that means the prices go up. I'm sorry, the prices come down and the yields go up. Yields go up, that means the rate goes up. So hopefully that helps you to understand it a little better. Our deep dive on the Federal Open Market Committee, and this concludes a three episode series. The first one where we did a dive into tariffs and how those are going to affect the economy going forward. Then the next one was the one big beautiful bill and all the tax provisions in it. And now the final one on the FOMC and how that all operates. And as always, I just want to bring you the facts. I want to bring you the data. I want to bring you the information and let you decide how you think this is all going to play out, and use that in your informed decisions as you invest in the future. So hopefully that was helpful for you, and we will see you on the next episode of The Invested Mindset. Thanks for joining us on The Invested Mindset. To continue receiving these actionable wealth building strategies, subscribe on Apple Podcasts, Spotify, or wherever you listen to podcasts. Make sure you turn on the auto download so you never miss an episode. And if today's insights moved you closer to financial freedom, please take a moment to leave us a rating. It helps fellow entrepreneurs discover these valuable strategies. I'm Tom Berry, and I'll see you next time as we continue building a path to lasting wealth and freedom.